Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alcana, along with Dennis Dick, and we have Tim Anderson on the line. He's the managing director at TJM Investments, speaking to us live on the floor of the New York Stock Exchange. Tim, how you doing this morning?
Good.
Tim, I got a question for you here, and we've noticed, I've been tweeting along with Furry Hamzy here, and I've noticed the last 6 days in a row, we've had some massive sell imbalances on the close. And what we're speculating is that there seems to be obviously some institutions here that are taking some money off the table. Have you been noticing these sell imbalances, and does that concern you at all when you see massive sell imbalances for 6 days in a row?
You know what? We have been noticing the selling. I don't know that they're massive. I mean, massive in my mind would be like, a billion or more for sale every day on days when it's non-program or index rebalancing related. Although I do not disagree with you at all that some institutions have been taking some money off the table. We've had a number of days in the last, probably in that stretch, when the high of the day was maybe mid to late morning. Mm-hmm. And then as you get into the afternoon, you start to get into a fade, and the last hour indicator during that stretch has not been real positive. There's no doubt that potentially some institutions could be at 2:30. They could realize maybe they haven't sold as much stock as they'd like to, maybe because the volumes are a little bit light going into the summer. So then that creates a scenario where they have, more stock for sale on the bell than they might otherwise want.
And maybe
we had a pretty good down day last week after the one day, and not really a snapback the next day. In fact, a little bit more of a follow through. The last time we had a down day of 200 points on the Dow, close to 20 handles on the S&P, close to 3 weeks ago, we had an almost total retracement the next day. So I think there is some concern about the potential for upside momentum here in the market.
Tim, we got a question coming out of the chat here, and the market just chopped around up there in a 2100 handle, finally gave way a little bit, and John Vitale is noticing here that we have dipped below the 50-day moving average. Is that any kind of an indicator that you use?
It's certainly something to watch, although it hasn't really been a major warning sign. There's been a couple of times where we've gone down and then touched the 100-day or threatened the 200-day. Some people were passing around some charts over the weekend showing that the last 5 or 6 times we dipped below the 50-day, within 2 or 3 or 4 days we're back up above it. So it's definitely something to watch. If the 50-day becomes resistance on any rallies from this point, it would be potential red flag. There's been a number of other pretty astute technicians that have said the chart on the S&P 500 quote unquote bothers them the last week and a half. And you're starting to get a little bit of a building feeling that the technicals are worrisome. Although the 50-day historic, for the last year or so, hasn't necessarily meant a lot, but you got to watch it, because if it becomes resistance, then we'll go into the 200-day.
Tim, what did you think about the trading action on Friday? A lot of the market was under pressure from the jobs number, but right after that jobs number 8:30, those financials started catching a bit here, and the financials were very strong. Is that because they think interest rates, they might be on the move here with this new jobs data, or what was your thoughts on the action in the financials and the overall jobs number on Friday?
It's such a great question, because the financials have just been have really, until the last couple of weeks, not really shown any leadership at all. And you got to question whether the leadership they're showing now is just because they're so cheap that they're an okay place to put cash, or if people think they can really start to get some traction in a rising rate environment. There's no doubt that financials like a rising rate environment. They like a steeper curve. That helps their cost of carry, although they don't, carry, they don't finance positions at the size they used to years ago. And as cheap as they are, some of them are trading at a discount to book. Some of them are just a slight premium to book. The issue is, they've almost become low-yielding regulated utilities. And they've become they've been at the wrong end of the battering ram of regulatory charges for the last 4 to 6 years, and almost been the personal ATM machine for the Justice Department and the government. So, if you were convinced that there wasn't going to be another round of $10 billion fines, and you were going to have a rising rate environment, and given the economic data we've had the last 2 to 3 weeks, the financials are attractive.
Well, and some people obviously were thinking that on Friday by buying them up there. What are your thoughts here on interest rates? After the jobs number here, obviously, do you think interest rates are on the rise this year?
I would think that the bottom has been put in rates, and that you're going to have some more upward pressure on rates. Now, it's going to be choppy. I mean, at one point, the German 10-year doubled last week from 0.5% to 1%. Now, 1% is still a very low rate, but on a percentage move, it's almost unprecedented. Our rates are at the highest they've been this year, probably the highest they've been in over 8 months. I think the Fed is going to raise rates in September. I think that the market is going to force them to. And I think that even the doves, or the moderates that lean dovish, are just going to be, they're just going to be forced to do a rate rise in September after the data we get between now and then.
Tim, I don't know if you're a Barron's fan at all, but Randall Forsyth, wrote a very interesting article about the liquidity time bomb. And, here you have, the Fed, the Europe, everybody just pumping liquidity, into this market. But on the other hand, some of these moves in the bond market, you would think, you think no one's home to be to making these markets. Is it just because of the Dodd-Frank regulations and stuff that people? I mean, that that could be a scary thing here. If if interest rates do go up, there's a lot of people heavily investing in the bond markets here. And if the liquidity dries up, we could have a real problem on our hands.
It's potentially very scary. I mean, I'm certainly not a bond market pro, but the people I know that are, or that I read, that I respect, are very, very concerned about it. It's definitely an unintended consequence, or maybe an intended consequence, hopefully not, of the Dodd-Frank regulation. The big banks and the big bond market trading firms are very hamstrung on how they can hedge positions and what the definition of hedging is. Some of it hasn't even all been written 6 years after the fact. And the lack of liquidity there, where, the bond market, dwarfs the stock market hundredfold in the amount of money that would trade there every day. And to restrict that, if you're going to have, maybe that's why we've had the real sharp moves in rates, particularly in European rates, the last couple of months. Nobody's really going to stick their neck out there and make a major stand with a multi-billion-dollar position. Because the big banks and the financial institutions and those classified as financial institutions can't. And you don't have a group of government bond dealers with enough capital. It's a problem. I mean, it's not a problem yet, but it's potentially a problem.
Tim, we talk about market leadership. You just did a great job of highlighting the financials here. Any other potential sectors that, in the last few weeks of the quarter here, maybe the institutions will be, sniffing around at any other sectors that may be providing some leadership here to this market?
Well, you got to watch technology because there's been some mega deals in that space, and that's certainly going to help valuation a little bit. Although historically, when you get a lot of deals in one space, it can be a little bit of an early warning sign of overvaluation also. I would think that even on Friday, you mentioned the financials acted much better than the market. Tech probably acted a little bit better. That's the other space to watch, because if there are potential deals out there that companies have been looking at strategically for the better part of a couple of years, and if those deals require borrowing a lot of money, and if those companies think that to get more convinced that interest rates are going up, they're going to want to do those deals and borrow that and float that, $50 billion bond offering to do those deals before rates go up, which is another little, that I think may even be fueling the M&A activity a little bit during the last 4 to 6 weeks. And it may fuel it a little bit more, the next couple months. If these corporate treasurers think that rates are going to go up, and there's deals out there that they've been thinking about, and if they think the economy is getting better, they're going to want to do that deal and sell that mega billion-dollar bond issue before rates go up another percent.
Tim, what are your thoughts on the transports here, too? Obviously, they have not been able to catch a bid, maybe a little bit last week, but we're really seeing pressure on the airlines, the rails. Obviously, have some doubt there as to say that, the weakness in the transports is not good sign here for the overall economy, and eventually this market might start to crater. What are your thoughts here? Can this market continue to rally without the transports, or are the transports just going to bounce back?
It can for a limited amount of time, but I think that the transports are below their 200-day moving average. It is an issue. You go a little bit further out, you may already have a little bit of a infamous death cross with the 50-day and the transports going down below the 200-day. You would think although oil's been up a little bit the last, well off its lows from February and March, you would think that would maybe be good for the airlines. It hasn't been. People are worried about, the airlines going on a, increasing capacity. The rails are very tough here because they're probably hurt by the pressure on coal. They're hurt by some of the shale activity being cut back. They're still, they still have a good business, but the transports had a huge move, 13 and 14. So, I do think it's hard for the whole market to rally, with the transports remaining under pressure. They have tried to bounce a little bit off their lows. You just got to see how they act once they run into their next resistance level.
Tim, real quick here, we only have you for another minute or so, but we'd like to get your comments on a few stocks here. Sears Holdings, getting a little bit of a bounce here. I guess the reconversion is keeping people a little bit interested in this stock. Your take on Sears Holdings?
You got to be a real hardcore believer. It's been such a disappointing stock for a long time. It is kind of tightly held, so it can be. He can make the stock go once in a while with a headline or a development or news of a big buyback. It's certainly not something that you can consider shorting because it's just so tightly held. But you got to be a real believer that the fundamentals there are going to turn around to buy it for other than a trade from time to time.
Raymond James making a big call on Walmart here. Strong buy. The stock has just been lit up here in 2015, going against the market here. You believer in a Walmart rally?
Yeah, I think it's still a great company. I think that the economy's starting to improve a little bit. You'll have them maybe get back a little bit of business from the dollar stores. Especially with the trend of higher minimum wage. Some cities going to a higher minimum wage. Walmart itself saying they're going to have a $10 minimum wage for everyone, and even running some ads around the country talking about how higher minimum wages help everybody. Well, it certainly will help Walmart.
Okay.
Tim, when they lost the market share, they lost it to the dollar stores years ago.
Yeah, Tim, we got to get to the imbalances here. Tim Anderson, Managing Director at TJM Investments. Thanks a lot, Tim. We'll talk to you again soon.
Guys, have a great week.